Okay, everybody. Okay, everybody. Can you hear me? Let me know that you can hear me loud and clear. We are about to have an amazing week in the markets. I'm excited. I'm fired up. I've got plenty of positive energy. Welcome, 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 welcome. Let's get after this, eh? Let us get after this. So just let me know, everybody, that you can hear me loud and clear before we carry on. I want to make sure that the sound is good. You will see my screen in just a little moment. Excellent. All right, so let's go. Let us go. Let us go. The sound you can hear in the background is my MetaTrader app. That means we are good to go. We are open for business. Awesome. Awesome. Right, so you're hearing that many pings because I've got 4 accounts open. So I think they're all coming online one by one. Let's take this banner off. And so welcome, everybody. This is Israel. I am your instructor on Sunday nights. Wirecast, no, Reggie, I'm using something else. I'll tell you about it in private, what I'm using. Good to see you. Sonny, Reggie, Gerard, who else is here? Esther. Good. So, right. So, as you saw, our webinar tonight is geared around, one second, let's just put this off. So our webinar tonight is titled Preparing for a Winning Week/month. In essence, how do you, as a professional trader, and we've explained when we say professional trader, we don't necessarily mean that you're a full-time trader. We simply mean that you are approaching the markets professionally. You're approaching the markets as someone who's doing the right things in the right way. So you're doing the right things in the right way to have the right result. You are approaching the markets the same way as you would if you traded it for your everyday income. And that's so important. The results will follow the approach. That's the way these things go. Similar to any other field of life. If you do things the right way, then the results will follow. You first become a professional trader before you start trading professionally. And even for those of you who will never trade professionally, you can still be a professional trader in your approach to the market. And that's what we teach you to do here. So also, in addition to the technical coaching that we do here at Israel Keys, a big component of our approach is what we call mindset coaching. I am actually a personal coach as well. In addition to a trainer, I work with clients, corporate clients, personal clients. And I have seen in every sphere of life, every industry, every form of endeavor, technicals are at best 25%, meaning your skill, your ability is at best 25% of your success. The remaining 75% is based on what goes on between your ears. The difference between great people and mediocre people sometimes is not talent, it's not ability, it's not experience, it's simply mental approach. And in nowhere is this more exacerbated than in trading. Your mind is your greatest asset in trading. You don't need to be a great technical trader. You don't need to know great amounts of information technically to be good, to make money, to be profitable. And you also do not need, what's what I'm looking for now? You also do not need to be a bad trader to lose money. It's all between your ears. And one of the elements of the psychological aspect to being a successful trader is your preparation. Uh, we are not reactionary traders. We are not, we should not be, I should say, reactionary traders. We should not be going into the markets just picking out trades willy nilly. We've made this very clear for those of you who've been, who started 2 weeks ago and last week. We've gone through some of this with you. You should be preparing for a scenario or predicting a scenario, waiting for a signal that tells you your scenario has played out, and then picking an entry based on that signal and then managing your trade. In essence, and I want to say this loud and clear, you should not ever go into a trade that you have not prepared for. Meaning, when you take a trade in the market, it should be that this was something you analyzed in advance, or when you see that opportunity, you go back and retroactively analyze what you are looking at. Now, the retroactive analysis is very, very difficult because your brain will trick you into saying, well, this is good, which is why we need rules. And we looked at that last week about the element of of a winning trade, building a trading plan. I'm going to continue and I'm going to go over this over and over and over again till you're blue in the face, till you're fed up with me, till you want to beat me up, till you like, stop it, we get it. I will know you have gotten it when you yourself are saying it every other second. You need a trading plan, and your trading plan should be able to fit on a postcard or an A5 piece of paper, not A4, A5. By a trading plan, we mean a list of rules that you go through to tick off to tell you this trade fits my profile. But we'll look at all that moving on. Also, one thing I want to show you real quick before we carry on any further, for those of you who haven't seen it already, is our weekly schedule. So this is our weekly schedule here at the Keys Wealth Academy. This is what we do every week, and so you can plan. You don't have to be at every single session, but all the sessions will be recorded and available on demand. Some are open, some are closed. For instance, this technically would have been a closed forum, but we've decided to open it up a little bit to our wider family, some of our subscribers, people who are not registered students, but who we want to give you a little bit of value for being supporters of our channel, for being part of our wider trading community. We're building something called a Traders Village. Reggie, I couldn't have put that any better. Thank you so much. Let me put that out there. No gambling. That is the summary. Do not gamble. Thank you, sir. So we have a wider community of people who are traders, and we're building our dream, in addition to raising and training students, is to build a virtual trading floor and a trading community with at least 1,000 traders to begin with, who are in community and inspiring each other and holding each other accountable, because this journey of being a trader is a lot easier when you have a tribe. And so if this is your tribe, whether or not you're a paid student, we want to do a little bit for you here and there. But the value the paid students get is unbelievable. For at the moment, for £79 a month, this is and this is just a third of the process. Let's show you this real quick before we carry on any further. Let's see if we can get this on the screen. This is just the mentorship schedule. Let me repeat. This is just the mentorship schedule. In essence, this is a schedule of mentorship webinars. This does not include, and I'm trying to find this somewhere. Let's see. Let us see. I think I know where it is. This does not include the pre-recorded systematic training system that we have in place, which is called the Market Breakers course, and our Mastermind Inner Circle. So this here is the full gamut of everything that you get when you are a registered student with the Israel Keys Wealth Academy. So the Market Breakers course, which is the step-by-step curriculum. What you saw just now was the weekly schedule for the VIP mentorship. And then for the advanced traders among you, you get the Mastermind Inner Circle, which basically takes your trading to the next level. If you find the same value anywhere else, come and speak to us. You will not find it anywhere else for anywhere near this price point. And it's not going to stay at this price for long. Cool. So Preparing for a winning week or month. What steps do you go through as a trader at the start of every week and every month? Let me repeat. Technically, you should do this every year, every quarter, every month, and every week. Every year, every quarter, every month, and every week. But since we are at the start of a new month and a new week, I thought it'd be great to show you this from a month and a weekly perspective. So the first thing you want to do is remind yourself. I'm going to type as we go along. By the way, I haven't looked at my chart since Friday intentionally because I want to come through this with fresh eyes with you. So I don't want to come through this with a bias. I want to come through and look at it from the same perspective as you will and see things for the first time so that we can respond to them live. So in essence, you're seeing the chart through my eyes in the way that I start the week myself. So let's put some stuff here on the screen. The first thing you want to do, 1 second, is to remind yourself, don't laugh, but this is very important, is to remind yourself what kind of trader you are. Very important. But some of you are asking, what do you mean what kind of trader you are? How many different kinds of traders are there? Well, there's a few different kinds. But for the purpose of this, what I mean is, what is your approach to the markets? It's very important. For instance, are you a scalper? This is all in the Market Breakers course. Are you a scalper, which means you are in and out of the market in 10, 15 to 60 minutes max? You like quick, short, sharp trades and you're in and you're out? Are you an intraday trader? In which case you are in at the beginning of the day and you come out at the end? Are you an intra-week trader? You come in near the beginning of the week, you come out at the end of the week. Or are you a swing trader? You're holding your trade for several weeks at a go. Or are you a medium-term trader? You're holding your trade for months. Or are you a position trader, meaning you can enter a trade in January and come out in May? You need to remind yourself that. Why? Because the way you look at the markets will completely change based on what kind of trader you are. So let me repeat. How you approach the market is completely determined by the kind of trader you are. The time frames you look at, the signals you're looking for, the scenarios that are playing out, how many different kinds of pairs you're watching. This is very important, and I'll show you why in a second. The second thing that I would do, so of course I know I'm an intra-week / intra-day trader, meaning when I enter a trade, I'm in for anywhere between a day and 4 days. I'm rarely going to hold a trade for more than 4 days. That changes everything about the way I approach the markets. The first thing it does, or the first thing that it will do or determine, is what I'm going to talk about in number 2, which is you want to build a watch list. And by a watch list, I mean a list of currencies or currency pairs that you will consider trading this week or this month if an opportunity presents itself. Now, for the new, I know this is an advanced session, but we do have quite a few new traders here. So I'm just going to slow down for a couple of things just to make sure I carry them along. This here, for instance, is the overall market watch list for my brokers platform. I want you to count how many different currencies I have a chance to trade. And this is just foreign exchange. I'm not talking about stocks or shares or indices or ETFs. This is just currency pairs. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37. So I could trade 37 different, actually there's more than 37, but 37 that it will let me trade on this platform. Depending on what broker you use, you could have a few. That's 38, 39, 40, 41, 42, 43. You get the point. And I see many of you struggle because you are trying, and if you just do the major pairs, the major currencies, that's the dollar, the Swissy, the pound, the euro, the Japanese yen, the Canadian dollar, the Australian dollar, and the New Zealand dollar. If you take those 7 currencies, and you swap them across each other, so 7 against the dollar, then each of the 7 against the other 7, you come up with 27 viable. Now, I wouldn't trade anything outside that. There's some pairs we call the minor, so the exotics, things like the the Czech koruna, the Russian ruble. Please do not be trading anything, at least for now, as a new trader with any of those currencies. The reasons why are in the market breakers course: liquidity, spreads, volatility, reliability. You just don't want to be trading them. But the standard pairs, the major currencies, you have 27 different pairs to choose from. In essence, I could slap 27 different, let me show you here. I could slap 27 different pairs onto this chart. Let's open up a new one. Right. Okay, I'm still in that risky trade from last week that I left open just because I wanted to be, I wanted to see something. I'm beginning to wish of course, the GU that I told you it was most likely going to lose, and it did. But I just wanted to see what was going to happen, and I did the same for the Swissy. Now, I could throw each of these pairs in here, see, and in essence, anyone I throw in, 27 different viable ones. If you try and track 27 different pairs during the course of a week or a month, you will make mistakes. You will get overwhelmed. You will make bad decisions. My advice, this is my personal advice, is every single month, come to the market with maximum 4 pairs that you're tracking. This is very, very, this is very, very controversial. And I know not everybody agrees with me, and that's fine. I don't need everybody to agree with me. Where was I? There we go. This is not for everybody, but if I'm your mentor, if this is your trading academy, learn the way we teach you first, and then as you become an expert, you can branch off and make your own rules as improvements and how they work for you. I say 4 max. That's just me. Why? Because I want to be able to track what's happening in the pairs I'm watching, even when I'm not taking trades. I want to understand the wider picture of what's going on in the markets, so that when a trade opportunity presents itself, I'm not just jumping in blindly, and to use Reggie's words, I'm not just gambling. I have big picture, long-term information. I know what that pair is doing. Like we looked at last week, I can place it in the long-term scheme of things. I have a long-term idea of where it's coming from, where it's going to, what it's likely to do along the way, and what it's doing right now. So that is so important. Build a watch list. Now, I put 4 in my watch list because of the kind of trader I am. If you are a position trader, if you are going to be holding trades for months and they take months to set up and you're going to stay in them for months, you can look at more than 4. So let me adjust this here. I say 4 max. Put that there as an intraday or intra-week trader. If you are a scalp, so if you are a swing trader, I would say no more than 10. 1 second. I would say no more than 10. If you are a scalper, I'd say no more than 2. The principle is this. The kind of trader you are will determine how many trades you take and how quickly you have to make decisions. If your trade setups pan out over, so for a trade you'll be in for months will take at least weeks to set up. You'll see the trade setting up over the course of a week. It gives you plenty of time to calculate what you want to do, so you can track several pairs at the same time. If you're a scalper, meaning you're going in, out, in, out, in, out, you're taking several trades a day, it's going to be hard to get the long-term picture of what several pairs are doing when you have to react in real time to several trades at a time. So for me as an intraday or intra-week trader, I'm looking at 4 max. Now, how do you build the watch list? This is the question now. How do you build the watch list? In a sense, how do you determine what 3 or 4 pairs I'm going to be looking at this month or this week, and I don't care what's happening in the rest of the market? Well, a couple of questions. Question 1 is, what does your time zone and or schedule allow? And I'm going to explain this. I live in London, which is GMT +1 at this time of the year. Other times of the year, it's GMT. And the vast majority of those of you who are a part of the academy, we've got a couple of people from outside, but I think 80% of you live in Europe or Western Africa. A couple of stragglers in the States. We love you guys too. What that means is the time of the day you are awake and able to work in the markets is fixed. Now, you could live in London and you could work at night and you're asleep during the day. That's fine. So you could be a night owl. And that's cool. But if you are a regular person and you live in London, you're going to be awake within the hours of maybe 5 a.m. in the morning, and you go anywhere from 5 to 7, you wake up, and you go to sleep anywhere from 8 to 11 p.m. at night or midnight. That picks certain pairs for you in and of itself. Because you want to pick pairs to watch, first of all, that will have high volatility in the hours that you can analyze or trade. And I'll show you that in a second. So you want pairs with high volatility at times you can analyze or trade. Okay, I need to continue that down there. High volatility. At times you can analyze/trade. And I will give you an example. Are you guys still following me? It's kind of quiet in the comment section. Just let me know that you're still there. So let's actually, no, I'm going to keep this chart open as my writing pad. Let's go to another one. So let's look at a 15-minute chart. Now, if you're an intraday trader, meaning if you're taking your trades and coming in and out the same day, the 15-minute chart is probably going to be your execution time frame, maybe a 5-minute chart, but most likely the 15-minute chart. This is where you're going to be managing your trades, entering, exiting, and seeing what they're doing. Each divide on a 15-minute chart is a day. So each divider corresponds to one daily candle. And we've explained why that's so important. For those of you who are new, go back and watch last week's webinars to explain why that piece of information is so important. So I'm going to slap on an indicator here that will show you something. And I want you to look very carefully at what you see. Insert indicator, custom. Right, let me see. So I'm going to go range, see impute. So 0 to 8. So 0 to 8 will be, no, that's not what I'm looking for. 0 to 8 will be, so I want this to start from my time. I'm 2 hours beneath my server, or behind my server. So for the purpose of what I want, midnight, so that'd be 10. Was it? No. Yeah, let's call it. So that's 10 p.m. Okay. Let me see. Okay, I'm just gonna slap on something real quick. So just ignore this for a second, okay? Right. So if I do 2 a.m. to 8 a.m. So I'm gonna do that just to give you a rough example. That I will correct that time in the future, but just for the purpose of today. So if you look back over the course of time, you will see that delineates a certain time period in the chart every single day. It will go back every single day and it'll mark out that time period for me. So this is 2 a.m. to 6 a.m. according to my server, or 8 a.m. according to my server. So that would be midnight to 6 a.m. here in London. That's not the exact period of time we call the Asian range, but it'll do for now, just to show you the point I'm making. If you go back and look at this time, 7 days out of 10, price isn't really doing much in that time period. You have the odd day, like for instance, like this day where it moved 27, 23 pips. But on average, it's a very small range. Like here, for instance, it's 12 pips. Okay, that day is, that the whole day didn't move much. Look at this day, for instance. It's 16 pips, but the entire day's range was 62. So you see, it's usually and also it's a consolidating period. Actually, let me correct that, because I'm trying to be cute here. Let me give you a more realistic time frame. Let's put this, because this is more like what we're looking for. Okay, so what did I just do? Yeah, cool. So anyway, yeah. So you notice that it's usually a consolidating period and a small time range. You do not want to be trading a pair. For instance, you don't want to be trading the EUCHF at this time. Now let's put the EU in there. Let's see what happens with the EU. It'll make the point a bit clearer. You can see that this is even worse. Now this is small, tight ranges, clearly defined ranges at that time of the day. There is little volatility. This is called the Asian pair. If you're trading pairs with both European and Northern American, like the euro, the pound, the dollar. Yep, Esther, good. You've been watching the beginners videos. That's good. The dollar and the Canadian dollar. You don't want to be trading them at this time because nothing much is happening. So if you live in a country and your schedule means, but your time zone and your schedule mean that this is the only time of the day you can trade, then the EU is not for you. The same, to a large extent, with the GU. Look at this. Same thing. Look at that time zone every single day. Look at how tight and small and consolidated it is. Not much happening. The same also to a large extent with the Swissy, the USDCHF. Same phenomenon. And it's very clear why this is happening. These countries have their working hours from roughly 8 a.m. GMT or 7 a.m. GMT to about 6 p.m. GMT. Remember, we trade with the understanding that 80% of the market is moved by 12 entities, 70% by 10. We call them market makers, commercials, big banks, liquidity providers, whatever name you use for them. These guys trade for a living. They're not like you. They're not addicted to trading. They don't trade for fun. It's their day job. The people who work for JP Morgan, Stanley Morgan, sorry, JP Morgan, sorry, Morgan Stanley, Chase, HSBC, Citibank, Merrill Lynch. Trading for them is a job. They do a 9 to 5 literally, maybe a 6 to 9, but still. They're charts doing their working hours, and then they pack up and they go home. When they are out of the markets go dead because they're not. No one's dumping great liquidity in any longer. The billions of dollars are no longer being put in the market. It's just a small fry like you and me putting our $1,000 accounts in there. The markets aren't going to move much in that time frame. You don't want to be in the market there for two reasons. One, you're not going to see good trading opportunities. But then secondly, those time periods are useful to help you plan what is going to happen for the rest of the day. You should be stalking the market at those times, gaining valuable information as to what's going to happen when the real thing happens or the real time comes. So you will not be able to take certain currency pairs based on where you live and your schedule. Now, if you live in a country where you wouldn't think you could take that pair, but your schedule means that you're awake or asleep at different hours from most regular people, that's fine. Just do what works for you based on your time zone, where you live, what is beneficial for yourself. So that's the first thing you look at. 1 second, let me put this down here. It's all a bit bunched up now. Now, the second thing that you want to bear in account when you're building a watch list is, 1 second, let me put this in. You want to quickly check fundamental drivers. Now, for many of you who are new traders, this means absolutely zero to you, and that's fine. You will learn about fundamentals as you go along. But you want to check fundamental drivers, and I'll give you an example. When Brexit was really going on, I stayed away from the British pound. It was not on my list because it was doing crazy things. Let me show you. In fact, this is okay. Let's go here. I'm going to take you back in the British pound over the last 3 years. On a daily. Okay, let's use a daily chart actually. Daily chart might not be able to take us back 3 years, but let's see. We had some wild periods of time. Let's use a forward chart. So we had, now look at this for instance. In this period of time, price stayed in a range of 430 pips for several weeks. That's not common because the market didn't have clear direction, because something bigger than just normal trading factors was affecting that pair. There was a whole country called Great Britain whose currency was held in limbo because politicians were making decisions. Look at this. Look at this jump, this gap. It's 229 pips. If you were in this trade and your stop loss, or if you were selling here, let me give you an example. If you were selling here, if you were selling and your stop loss was here, right? If this was your 1% stop loss, for no fault of your own, price would have gapped against you by 200 pips. 200 pips on the 10th of December last year. So if this was 1% for you, you would have lost, let's see now. So that's 47 pips. 47 pips. You would have lost 1, 2, 3, 4, 5% of your account before you could even do anything about it. And you didn't need to be a genius to figure out what was going on. The Brexit conversations were taking place and the pound was doing some weird stuff. There's a particular day I'm looking for. Let me show you this. See this here? This is 1 week in March this year. In 1 week, it dived Yeah, was for about a week by 1,753 pips. So you want to quickly check what's going on fundamentally. Is there a crisis? Has there been a hurricane? Is there a war? Is a country trying to leave a union? Um, is there a corona pandemic? This one was the coronavirus. This one here was the coronavirus. It affected most pairs. And so also the fundamental drivers will tell you, even if you're going to take a trade, stay in one direction. So it's more likely you stay north or south, long or short. So you want to quickly, let's say quickly check fundamental drivers. And I should put a couple of them there, but I won't. Now, moving forward is where it begins to become technical. I only trade majors, meaning the 7 major currency pairs against the US dollar. GU, EU, UCHF, AU, and NZU, and UCAD. So I have something called, and I've told you guys this several times, a reference index. Now, your reference index will depend on how you trade. For some people, your reference index will be the S&P 500 or the NASDAQ or the FTSE 100. These are all stock exchanges of the UK or the US. For some people, it will be the bonds market, the futures market. It could be a commodity like wheat or oil or whatever it is. Depends on your trading strategy. We're going to get further into this as we go along. But you want there needs to be something before you start looking for a currency pair that you look at to give you a generic, neutral assessment of what you think the markets you're involved in will do this week. Now, if you look at the bottom of my charts, every single pair there has the dollar in it because I only trade dollar pairs. Also, I am awake between 6 to midnight UK time, so I trade European currencies. The EU, the USD CHF, and the GU primarily. These pairs will be awake while I am awake. The guys in Europe for the euro in Europe, the pound in Britain, and the Swissy in Switzerland are roughly on my time zone, maybe 1 hour either way. The US guys wake up 6 a.m. their time in London, in New York, is 11 a.m. my time in the UK. So when they wake up and they start trading at 6 a.m. their time, it's 11 a.m. my time, I'm already awake. By the time I am sleeping at 11 p.m. at night, 12 midnight, they would have closed their day at 6 p.m. their time, 7 p.m. their time. So for me, it makes sense. And of course, I also know that for European pairs, the Asian range is very unlikely to move a lot. So for me, personally, I am usually tracking 3 pairs most of the time. The EU, the Swissy, and the GU. So fiber, cable, and Swissy. Euro dollar, pound dollar, or dollar Swiss franc. Let me repeat that. Let me put this in to repeat that for you. Where is it? So Asian range. As you can see, while I'm asleep, the pairs aren't doing much. That's why I like them. I'm very unlikely to miss out on most moves because the period of time I'm asleep, the pairs are not doing much. And when they really start doing the most, I'm awake. Now, how do I know which of them to track this week or this month? Well, My reference index is the dollar index. This is a measure of what the dollar on its own is doing. There's one for the pound, there's one for the euro. You could, some pairs track well with certain foreign exchange markets or assets like gold or whatever. But for me, this is my reference index. It gives me a neutral assessment of what the underlying asset of most of my pairs is doing. So for instance, all the price action principles that we teach on the pairs, they work on the dollar index. We don't trade the dollar index, but it gives us a filter for our trading. For instance, let me give you a quick example here. Shapes, rectangle. So we had an order block there. And if we refine it, this is the 4 hour. If we refine it, that's the refined block here. We see that on the dollar index, the dollar breaks market structure there. So we looked at market structure already. This is the market structure break here. If you haven't been around the last week, please go back and revisit the videos. We took plenty of time, Talkbear and myself, to break down what the MSB or the market structure break is. The market structure break was the one principle that transformed my trading. It's the single most important principle for me in the markets. When I saw it for the first time, when I learned it for the first time, my trading transformed. So this is the market structure break there. And then we see price come back into that level and find support. We looked at that last Friday. Find support there. But not only does it find support, there's a stop hunt. Can you see that? Let me know if you can see that. Now, we're not trading the dollar index, but we're tracking what's going on here. So that's a stop hunt. So stop hunt into a liquidity profile. Now, this is from last week or from 2 weeks ago. But bear in mind, as at this time here, we don't know what was going to happen. All we see is this. So this happens, first of all. There's a market structure break there. Okay. Price comes back into the zone. Now, you guys know that we're not taking that trade, right? Single currency chart up. Okay, Reggie, I will show you how to do it. Okay, so if you come to new, it depends on your broker, but on my broker here, create new chart. My broker, it's under charts. In some brokers, it's under the tab that says indexes. But just look in every single subsection until you find it. It's EURUSDX. Now, there's one for the euro. You can see the euro one there. But this is the dollar one I'm working with at the moment. So for instance, you could be trading European pairs. Fine. So you're only trading the majors against the euro. Whatever works for you. I'm usually trading the dollar. But if the dollar is, for instance, if the dollar is in a period of time where it's not doing much, I will switch to the euro as my filter, and then I'll start trading Euro GBP or Euro Swissy, or maybe something like Euro Jappy. But it's this one. Oh, what have I done? What have I done? Okay. Let's see. Can I undo that? I don't think I can undo that. No, I can't. So I've got to put all that in again. That is so annoying. All right. Template. So I've got to start again. Anyway, you get the point. We'll just start again. So you saw the market structure break anyway, and you saw the stop hunt. So we know we're not taking that signal because we're waiting for a liquidity, an intermediate liquidity to be rated, stop hunt. So when this happens, when that comes back down to that level there and creates that stop hunt, this is an example of what we would call a signal. What does it have to do with preparing for the week? I will show you. This is what we call a signal, right? So that's our signal. We have a return to the order block that has taken out an intermediate low there. And if we were to put our Fibonacci, we are not surprised to see, let's do it the other way, the way I taught you. We're not surprised to see, let's see where that is. So that's the high and that's the low. Yep, that's at a discount. It's in between the 38.2 and the 21.4 level. So that's a discount. So that's a valid trade, right, guys? However, before this came in, the moment this happens, we should be expecting that to happen as a potential, because we have seen a market structure break that was preceded by a 4-hour stop rate. So on a 4-hour chart, which is my reference chart as an intra-week trader, price goes below that low, comes back, and then so in essence, we have a bullish reversal according to our class on Friday. And so from this point, we are waiting for that signal. Well, if we know that we're waiting for a bullish expansion on the dollar, we just go into every single 4-hour chart on a dollar pair. So let's start with EU, right? Let's go look for it now. EU is inversely related. One second, let's find this here. So I'm going to put this there. And I'm going to put this there so you can see it for yourself. EU is inversely related. Let me get that trade off the screen. So this happened 1, 2, 3 weeks ago. Well, we see the same thing here, don't we? So this is the 4-hour sweep, right? It's just the opposite. If it's happening upwards on the dollar, it should be happening downwards on the EU. And so we're going to ask ourselves as a filter, is this same pattern we're seeing in the dollar, is it setting up on EU? If it is, then we add EU to our watch list. So look at this here. I'm going to show you one by one. This bearish move past that 4-hour low. Also, if we look at this here, that level is significant. See that here? See that where the daily candle touches it and respects it there? Well, that's the same level here. So there is a significant level. This is all part of our trade plan session. There's a significant level from the past there. Well, we'll ask ourselves, is there a significant level in the past on EU? Yes, there is. Similar. It's running in there. So I'm going to put 1 second. Can you see that there? So that daily candle there is the same as this one right there. It's the same day. So at that level, do we see the EU do what we see the dollar index do in the opposite direction? And the answer is yes. The dollar index comes into that level on a daily and it reverses out of it. The same thing happens in the EU. It comes in there and it reverses out of it. So the moment that happens, I'm putting EU on my watch list. Now, if EU keeps blowing straight through that level and keeps carrying onwards, then I know, okay, I can't use my reference index to track EU. I take it off my watch list. Why? Because I want more confirmation per currency when I decide to take a trade. So I'm giving myself some pre-filters to tell myself this currency is likely to do what I'm expecting to do. Secondly, let me take this off the screen. Because in addition to showing you how to prepare for a week, I'm also showing you some very, very valid trading concepts here. So please bear that in mind. Then we see the market structure break happen there. Well, we also see a market structure break happen here. So 1, 1, 2, 2. So this is setting up real nicely. And then you see this order block here. Well, we have the converse order block here. There. Price touches it here. Price touches this one there. There is a stop rate there. Back into that original order block. Well, now we do not see that happen there. So according to the strict dictates of the law, we are not taking this trade. And as you can see, when this one happens, price breaks that low. Price breaks, sorry, that high there. But in this case, it does not break this there. So because it did not meet this criteria, we would not have taken EU. It would have been on our watch list, but when the time came for the signal, based on this, we couldn't trust it. Now let's look at GU. Let's look at the same principle, 4-hour chart. Again, we're looking at the inverse correlation. So 1, 2, 3 weeks ago. 1, 2, 3, 4. So there's the high there. So that's the original. 1 second. That's the original sweep. And then that's the market structure break. Here. Now, in this case, it doesn't go back to the original order block, but stay with me. We told you there's several different types of liquidity profiles. There's one we haven't shown you yet, but that would be this one here. It's a special kind of order block. We'll show you in the future. So this touch will be this touch there. And then we do see that it does, in this case, take out the intermediate high there. Do we have? Yep. It's coming to an area of premium, 61.8. So we sell at a premium, we buy at a discount. And so this is now a valid trade. And so at this point here, we're looking for a reason to sell. The moment we see this happen here, we're thinking sell, 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 sell. And what do you know? We got a nice 300 pip trade just 1 week. But we got this trade because we were tracking GU the moment this happened, because we saw it happen here. Does that make sense? Okay. Let's go back here, I think is where we were. Now, what else? So you build your watch list, meaning these are the pairs I'm tracking. Now, another factor in building a watch list could just be preference. Some traders just like some pairs. I like EU. I understand the EU. I've been tracking EU for 12 years. I know every single major move that has happened in the euro dollar over the last 12 years. It's patterns. It's preference / familiarity. And this is why I really don't want you trading 15, 20 pairs. Because you want to get familiar with one currency pair. When you see certain things happen, after a while, you have a hunch based on how you know that pair moves. You know what time of the day this is going to happen, what rules to look for, what signals. And so this is a factor. But you build a watch list. Okay. Now, after you're done building your watch list, one second. You do what we call intermarket analysis. And I've shown you a little bit of that already by going to look at the the dollar index. But then this is where you also look at things like inversely correlated pairs, other asset classes like the stock market. There's some principles that we will teach you when you get to the advanced stage. I'm not going to show you that now. One, you haven't paid for it yet. That's high level stuff. But then secondly, we don't want to bore you. But there's things that I look at every single week and month before I go into the market. When we have a real closed door session, I'll show you some of them. I'll give you an example of one of them. Just one of them. There's something called open interest for the experienced traders among you. Open interest. Go study open interest. Go Google it. Open interest for traders. I look at the open interest coming into that week or that month, and it will filter out certain trades for me. So that concept of open interest, there's another one I'm going to give you for free. Just going to mention it. I'm not going to show you how I go about it. It's called the Commitment of Traders Report. These are pieces of information that tell you large scale. This is some of the information the banks use, the market makers use. Based on what open interest and commitment of traders are saying, it could tell me this 2 or 3 trades or 2 or 3 currencies are very likely to do very well this week. Because I'm looking for excuses for volatility. I'm looking for something to suggest to me that this trade or this currency is likely to move several pips in a discernible direction. I want something that I can predict it's likely to go several pips south or several pips north. But I've given you an example of how to do that with the dollar index. The fourth thing I do when the magic starts to happen is top-down analysis. I'm going to give you a little bit of examples of this live. All right, so let's open another one. Something I haven't used to teach or whatever. So what's this doing? Lord have mercy. These pairs are just wild. They're just wild. Okay. Now I'm going to stay into that trade and see what happens. If it loses, it loses. But I'm going to stick with it. I just want to see. It's 1%. So, right. Let's see. Okay, let's use this one. Now, I've shown you guys before, when you're doing top-down analysis, you ask yourself, what chart am I really trading? And the chart you're really trading is the chart that determines what kind of trader you are. So I am an intra-week trader, which means I am going to be trading the 4-hour chart. Why? Because one divider on a 4-hour chart is a week. I expect to be in and out of my trade over the course of a week. Therefore, I want to be trading the time frame whose divider is a week. Does that make sense? Because what I'm literally doing is having an informed guess. It's a highly informed guess, but it's a guess nonetheless. An informed guess on what my next candle is going to be. I really don't want to show this again. I've shown this several times over the last 2 or 3 weeks. How every candle, Reggie, I'm going to show you because I don't think you were there with this. I'm going to show you real quick. Let's take any candle, right? Let's take this last week, right? Was up. It started here, it went up here. 9 times out of 10, when you see an up candle like this, price starts at the open, dips down into a support, runs up into a resistance, and then comes back down and closes. So let's look at last week on a 4-hour chart. Can you see this? It opened here. It ran down into a support level. What support level? Well, let's look. Let's see. I can guarantee you there's some. There we go. You see this touch here? There we have it. So this is a significant level from time past. Price gets there. And so by the time you come into the week, and I'll show you in a second, you should have this level already delineated on your chart. You should go back on a weekly chart and on a daily chart, and you would mark out significant levels. These are all parts of top-down analysis. I'll show you this in a second. I'm just going to put them here. These are the levels I would have marked out going into this month already, or into last month that's already ended. Some above and some beneath. Because we would have been here in price, and then for the other way, I'd put that there. I'd put... These are the significant weekly and daily levels from the past coming into that particular week. Put one there. And you will notice that when you start trading, I'll put one there because that's the last week's high. Price is going to respect these levels like magic. Put one there because that's the previous week's low. And then price was unlikely to get here, but I'd still put them in anyway, because you never know, you could have a market spike. And these are just simple levels where price did something significant in the past. So here, 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 here. Just, I just throw in a few. Now, the question is, what's the price likely to do this next week? We don't know. Is it likely to go up or down at the start? We don't know. However, let's apply price principles. We have an order block here, and this is why you should really take a few pairs and track them all the time, because they give you insights. So, oh no, not you. I don't want a text. I want a shape. So there's an order block there. Right? Price leaves the order block and comes back in. See that? So this is a bullish move. We expect a reaction in that order block, and we get it. Where is the reaction going to happen? We don't know. But at the start of the week, if this is here, we expect price to find support somewhere in that week and then start to push up. If we expect a bullish candle, we know on a 4-hour chart, the week's going to start, price is going to drop down, find support somewhere. Where? It could have been here. This is the first significant level, but does price react to it? No. It does a little bit, but it keeps going to the next one. And at the next one here, we see a sharp reaction. That sharp reaction coincides with this order block here on a 4-hour chart. And then we see a 4-hour engulfing that pushes up back here. Price then begins to go where next? To the next level. See, we drew this levels in advance. The next level stops it here. It comes up into that one there. It doesn't reach that one. And it forms another order block there. And then it settles at that line for the week. But coming into the week, I do my top-down analysis. So if I'm trading the 4-hour chart because I'm an intra-week trader, I start my top-down analysis from the weekly. If I'm a swing trader, meaning I'm trading the daily charts, because I intend to be in and out during a month, because on the daily charts, each divider is a month. So I expect my trades to last 2 to 3 weeks. Then I'm starting my top-down analysis on the monthly. If I am a scalper or intraday, meaning I'm owning the market for several hours or less, in essence, I'm in and out in the same day, then I'm trading anything from the 1 hour downwards, because from the 1 hour downwards, each divider is a day. And so the same principle would apply. I'd go and mark out my significant levels coming into that week, above and beneath. And then on that chart, ask myself, what is price doing long term? Here, there is a clearly discernible direction. There is a market structure break here on the weekly chart, and price has come back into the weekly order block. So I can reasonably expect a bullish week. Therefore, when I drop down to the 4-hour chart, I know what I'm looking for. However, there could be a pair where it's not that clear. Let me see if I can find one. One second, I'm going to have to open up another chart. You could have a pair where it's not that clear. And if it's not clear, then you take that pair out of your watch list. In essence, if going into the week, you cannot discern from top-down analysis a macro scenario, then you stay out. For instance, look at this one here. There's a gap here. And then price comes back here. Now, you could argue in hindsight that that level is there and therefore this trade could be expected. You could argue. But can you see how this is not based on the principles we've shown you so far? You can make this argument because as you go along, you'll see why an experienced trader could have expected that. But for where some of you are, this hasn't come back to an order block. The nearest order block is up here. And so as far as you know on a weekly chart, this has not been fulfilled. And it still could be to happen. Price does that and then comes back there. This could very well still happen. The point I'm making is, based on how you trade, with the principles we've taught you so far, you would not be looking for a trade. Even if you were in the right time zone, right schedule, you would not be tracking UCAD this week because you cannot see a top-down analysis scenario that it's given you if you are a 4-hour trader. Now, if you're a daily trader, okay, then there might be something to work with here, because on a daily chart, well, let's see, what would you tell yourself on a daily chart now? I don't know. So on a daily chart, let's see, I think I see what you would tell yourself. So There's an order block there on the daily chart. Price runs away, comes back and just touches it, and then you see an engulfing. So after this day there, you would expect price to come back in there, and then you could have taken a trade short on Wednesday and Thursday. But now, if you're scalping intraday, that's still a decent chunk of change. Let's see, that was still 80 pips. So for a scalper or an intraday trader, that's fine. For an intra-week trader, that's nothing. So you can see how, depending on how you trade going into that day or week, you would tell yourself, okay, I have something to look forward to in UCAD or whatever pair, or I don't have anything to look forward to. However, on, let's see, what pair were we on just now? On, where were we? I keep losing, okay, yeah. But on GU, it worked out just perfectly. We had a clear expectation directionally. Coming into the week, we knew we were in this order block. Also, remember what I taught you guys about discount and premium? It works for order blocks as well. Let me show you. It works for order blocks as well. If you know that this is the order block, in essence, remember what an order block is. It's a clearly defined range of activity where a market maker did buying or selling. Someone with deep pockets determined that this was a significant zone. Well, if you put your Fibonacci on that zone, I keep doing it the way I've done it for years. But teaching the new students, I've taught them to always draw it from high to low for a reason. So something is obvious to them. Because as you get more experience, it doesn't matter what direction it is, you can still see it. But for the new students, we don't want to confuse them. So we always do it from high to low so that 100 is at the top and 0. So anything above 50 is expensive. Anything beneath 50 is cheap. Premium, discount. Let's drop down to 1 hour chart so that we can see this bigger. So that's the same order block on a 1 hour chart. The range between 61.8 and 38.2 is the fair value range. This range here is the fair value range between 61.8 and 38.2. That's the fair value range. So anything above that is expensive. Anything beneath that is cheap. You want to buy at a discount, but you want to sell at a premium. Now, you will notice this. If an order block, so we taught you to draw the Fibonacci's from high to low in expansions, because the expansion is the range the market maker thinks price currently is in. And so in that range there, they're going to want to buy at a discount. So there you see it. If it's the other way around, they're going to want to sell at a premium. And so it'll be the other way. But an order block is also a range of price that a market maker has determined to be important. And you will notice that several times it is in that fair range, usually around 50, when price returns to the order block, that the business happens. Because they have determined that to be the range that moved price, propelled price north. When it comes back down, again, they're looking for roughly equilibrium in that price range. Somewhere in that middle is where you usually see the action. And so on a weekly chart coming into this last week, we could have been hunting price getting there and looking for reaction. Well, you drop down to a daily chart. Actually, let's go down to a week and a 1 hour chart to show the principle. Now remember the rule. So this is the region we're looking for. Friday. So this is Friday, Thursday, Wednesday, Tuesday, Monday. Let me put that in so you can see it. Guys, let me know if you're still here. I want that you're following me, sorry. So this is Monday. You're going to see this happen all the time, right? All the time. That's Tuesday. This is Wednesday. And that's Thursday. And finally, this is Friday. This is textbook. This is like taking candy from a baby. If you have clearly defined, so this was Friday last week, right? All right. So remember now, when you're looking at a 1 hour chart, it looks exciting. Price is going up, down, up, down. This is the benefit of top-down analysis. On a weekly chart, what's really happening? This is what's happening. Price came out of this order block here. How many weeks ago? 1, 2, 3, 4, 5, 6, 7 weeks ago. It came out of that level there, right? It broke market structure. Market structure breaks on a weekly chart are gold, right? It breaks structure there and comes back into the order block. The moment it starts coming back into the order block, you are tracking it. On a daily chart, you're tracking it. Now, can you do this with 27 different pairs? No. This is why, now, if you're just drawing trend lines and taking MACDs and stochastic crossovers, fine, you can track 20 different pairs and you won't understand a clue about the market and many of your signals will be wrong and you wonder why you're not making money. If you're trading correctly, you don't want to be looking at, because you want to be able to follow this process. So it's coming back down. The moment it hits the order block, you're watching day 1, day 2, day 3. But remember, when it comes into the order block, you are looking again for a stop hunt. Remember, you want somebody to be punished for being too eager. And in the past, many of you have been that person. Look at this. Remember, price is fractal. The same thing that works on a 1 hour will work on a 4 hour and a weekly. It's the same principle. There's an expansion, a retracement. Let me take this Fibonacci out of the way for now to show you. So there's an expansion. That breaks market structure, right? There's a retracement to what? To a discount beneath the 61.8 level. Well, okay. Let's draw it this way. So for the sake of the new guys, as you get more experience, you realize that 61.8 one way is 38.2 the other way and vice versa. But here, into the discount area. But in between, there has been a liquidity hunt here. This guy here is usually many of you. This guy here is me. I'm waiting for you to have your stop run out and be punished for being eager. That tells me that the market maker is ready to go. The moment you see this and it starts coming back down, you are waiting because you know what is likely to happen, because you've done your top-down analysis, right? And as you can see, you're waiting for it to get to roughly the fair value range in the order block. Just drop down to a 1 hour chart. Now, please type in the comment section, what days of the week have I taught you before that in an up week, so we're expecting an up week from the top-down analysis, in an up week, what days have I told you that the low of the week is likely to form? Please type it in the comment section, please. Nobody yet? Come on. Okay, you guys on a delay. I forgot. So you're hearing me literally about 30 to 40 seconds later than I'm speaking. But can somebody type for me in the comment section what days of the week I've told you to expect? You're right. Tuesdays and Wednesdays. Remember, we know this seasonal tendencies. Certain times of the week, day, month, or year are usually significant. Okay, so Gerard, thank you. Or actually, yeah, both Gerard and Thomas. So can somebody tell me what times of the day? No, not actually, that's wrong. It's Tuesdays and Wednesdays. Thomas, you're wrong. Or Joshua, sorry, you're wrong. It's Tuesdays and Wednesdays. Now, what times of the day are we expecting these moves to happen? What times of the day? So we looked at the days of them. So Tuesday and Wednesday is usually when a professional trader will expect a market maker to move. Why? Because they're using Monday as a manipulation, the same way they use the Asian range as a manipulation intraday. Also, the same way they use sometimes the first week of a month as a manipulation. But that's all beyond the scope. So someone type it out for me. What time of the day? I'm just going to type it for the sake of time so we can carry on. We're looking between 6 a.m. to 10 a.m. UK time. Okay, if somebody has got it. So let me just put it. So 6 to 10 and 12 to 3 UK time. We know that to be true, right? Well, so on Friday, price is dropping. And we are waiting for this to be taken out because we know on the daily chart it's intermediate liquidity. And so when we come into Monday that week, on Monday, we hit that level. See that we come there for the first time on a Monday. But it's a Monday, right? So we don't trust it because it's a Monday. Look at that silly trade now. Now it's moving like it should have moved when I was in it. Anyway, so we're not going to trust it on a Monday. But if we come back on also, it gets there what time on a Monday? It gets there at 6 p.m. on a Monday. So the end. So 6 p.m. here is 4 p.m. UK time. My server is 2 hours ahead. Take that off. My server is 2 hours ahead of the UK on my chart. So it's the wrong day, wrong time. I'm not buying it. Literally, I'm literally and figuratively not. I'm not buying the signal in that I'm not going to enter a buy trade, but I'm also not buying what the charts are telling me. But on a Tuesday, it comes back there into that same spot. And now we have an order block to frame it from. That is now the order block there that we're framing it from, right? So let's drop down into Tuesday on a 15-minute chart. This is Tuesday. I'll just show you that it is Tuesday. So see, this is Tuesday, right? Okay. So on Tuesday, price comes back down in there. And it follows all the rules. It opens up here. That's the open of the day. So you see, now this is how those rules apply. You don't just say, okay, this is Tuesday or the beginning of the day, I'm good. No. Your top-down analysis gives you all this information, and then you can execute with precision. So it's Tuesday, price opens, it drops down beneath the open of the day, where into the order block from Monday. Why? Because we are now in that sweet spot. We are in the daily fair order block here. We've had the weekly market structure break, a return, a deep retracement, fair value in the order block. There has been an intermediate stop hunt. Everything is set, right? and it's playing out according to precision. So this happens here. And then, like I told you, my personal signal, everybody has your own signals. My personal signal for the way I trade is an hourly engulfing. That tells me that this particular setup, the way I trade, is good to go. This is my hourly engulfing here. You could argue it's this one really, but I'm likely to take this one here. But even if I take the higher one, that's fine. If I put that there, in essence, that's the entry of my trade, right? I could now, 1 second. Oh, I can't. Okay, anyway. 1 quick second. Let me switch this to a pair that I can trade to show you. Oh, by the way, I should let you know this. When you open your Market Watch tab, that's Control M, or you just come here to where it says View and click on Market Watch. The first time you open it, it will only have a few pairs there. It could be 6 or 15 or whatever. But if you click in the space, right click in the space, and click on Show All, it'll bring them all up. And so this is a zero spread account. So I'm looking for the zero spread current actually. So yeah. Oh yeah. Yep. So if I do this, why isn't that? 1 second. Insert indicator custom pre-order tool. 1 second. Okay. There we go. And so this would be my entry. My stop loss would be down there. But like I said, I'm just going to, this is where I know that the engulfing has happened. So I'm going to put that there. And then 1%, 2%, 3%, 4% the first day. It dips back down. 5%, 6%, 7%. You guys saw me take this trade the second day, right? Now, remember I've told you, especially as beginners, always wait for a daily engulfing. I told you, right? Oh, yeah, but I'm going to, well, true. You would have missed the beginning of the move, but you could also have saved yourself from a loss if it carried on going south. But if you wait for the daily engulfing, then you now know that that signal is ripe. Well, the next day, you just go wait for the trade. What are you waiting for the next day? Very simple. So this was Tuesday. So let's assume you didn't take the trade on Tuesday. You were waiting for the daily engulfing on Tuesday to confirm that you were correct, right? Or a cheat mode to that is you just simply wait for it to take out the high of Asia that day. And then anywhere above that, you have a valid trade. But let's assume anyway that you just waited. Well, the next day, you know the same pattern is going to repeat itself. Price is going to open. You expect it to go up. You wait for price to dip below the open and find support. Where do you expect it to find support? Previous day level. So where are the previous day levels? Again, a couple of order blocks. There's one here. But if you weren't comfortable enough about that one, 1 second. So there's one there. And there's another one. You can't see it on a 15-minute chart, but if you drop down to a 5-minute chart, you will see it. But you can spot with some experience another one there. So either of these two would have worked. I usually go for the lower one just to be on the safe side. Sometimes it means you missed the trade, but I'm just risk averse as a trader. So I would go for that one. Well, there you go. So again, you wait for a 1 hour engulfing in that region. There's your 1 hour engulfing. You put your entry there, your stop loss there, entry there, and entry there. Come on. All right, 1 second. Okay. Come on. What's going on here? Okay. Anyway, you get the point. That you put your entry there. Stop loss beneath the zone. So that would be 23 pips in the same day. Literally over almost 5-1. Now, bear in mind, this is the wrong time of the day. This is 5 a.m. So let's assume you were asleep. Actually, that's 1 second. No. 1 second. Actually, that is the right time of the day. That's 8 a.m. So yeah, that's valid. 6 a.m. in the morning. It's a valid trade. Even if you missed it because you were sleeping, look at how it gives you another chance. Because remember, elephants can run through they can't run through your garden without letting you know they're there. Look at how it comes back down. So once it breaks structure that day, it comes back down. And this is the key to the way I trade. The majority of my trades now, I take them during 12 to 3, which is the New York Open, because I'm praying or sleeping in London. If I was right about the direction of the day, even if I missed the London move, New York will usually give me a second chance. And here you have the second chance in New York at 2:30. So that's 1:30 UK time. How do you find it? Very simple. The low of the day to the high of the day coming into New York. And you wait. Anyway, 78.6 is just 21.4. You get it. It's the opposite. It's a deep retracement. That's all you need to know. It's beneath the middle point. And so this now becomes your entry. Where's the zone? You're framing your entry over. It's this order block here. So you would have your entry there, your stop loss down there. 1, 2, 3, 4, 5, 6, 7% or 7-1 in the same day. And then you keep it moving expeditiously. But it all came out from top-down analysis, right? Going into the week, you had done top-down analysis from your higher time frame to figure out what you expected. This week, I'm going to show you guys how to work with 3 time frames. Your reference time frame, your bias or directional time frame, and your execution time frame. But for today, 4 hour, weekly, 15 minutes and beyond. And you do this coming into the week so that when the week starts to unfold, you are not reacting. You're in sync with what you expected, right? Now, having said that, before we close today, I'm going to do this real quick with one pair for this week coming. Let's just see, what do we expect in one pair for this week coming? So let's do the EU, which is my favorite pair. So let's do that real quick. Top-down analysis, 4 hour chart. Is there a discernible direction? Now, first of all, actually, we're working from here. So we've seen already that the EU is out of sync with the dollar index, or what was out of sync with the dollar index for the trade from 2 weeks ago. It doesn't mean that it's going to be out of sync forever. So let's go back and look at it. Has it gotten back in sync now? What's it doing? EU. So this is the weekly chart of the EU. What's happening here? Well, I did this last week at the start of the week, but let's do it again. So we've had a market gap here. This is on the weekly chart. We've had a market gap there. For now, just know that every time you see a gap in the market, price will usually want to come back and fill the gap. The whys are not relevant for today. You will learn them in the market breakers course. But when you see this happen, especially on a 4-hour or above chart, price is going to come back there. So we knew it was going to come back there. So what's really happened here is there's been a market structure break on the weekly chart there, right? Price has come back in to fill the gap. It's giving us, let me draw the Fibonacci the way I taught you guys to do it. It's giving us a discount retracement here, 21.4. And then it's taken off. But if you realize, when it came here the first time and took off, it spiked back down beneath it. Why? This is where the fundamental drivers come in now, right? Why didn't it just carry on going from here? Simple. Not Brexit, Corona. This was the week, the first week in March, where the bottom fell out with the coronavirus, when all the government started shutting down. So we know that this here could be an aberration because it was caused by a virus, a natural quote-unquote disaster, but then it carries on the other way. However, it hasn't broken structure to the upside again on the week. See that there? This activates, for those of you who followed me through last year when we looked at the 3 market profiles, reversals, continuations, and reversals, consolidations, and trends. This sets up a consolidation profile on the weekly. So we know that on the weekly, until that range is broken, price is consolidating. This is the range here. Until we see price conclusively break out of that range, we are going to assume that this is a weekly consolidation. Now, it could be trending on a lower time frame, see? But on a weekly time frame, we understand that we're in a consolidation here. This entire region here, and as you see, when price comes to the bottom of the consolidation, 1, 2, 3, 4, 5 times, and it runs off. But when it comes back to the top of the consolidation, 1, 2, 3, 4, 5 times. So, because we are at the top of the consolidation here, we are going to assume that price is going to be bouncing from top to bottom until it conclusively breaks out one way or the other. Until we see this, till we see that. So this is most likely how we would know. It would break out that way. It would come back down near the middle. And then it would it would finally leave. This will work on any time frame. We're just analyzing the weekly, but this pattern works on all time frames. Or it breaks south, comes back, and then goes. So until we see one of those, we should assume that we're in a consolidation. If we are in a consolidation, when we got up here, we should have expected this to happen. And we see it. One, this is why price isn't moving that much on the EU. This is why it didn't respect the order block, or sorry, the dollar index's bearish move like GU did, because EU is being held in a consolidation pattern here. Also, if you look at the macroeconomics, things I can show you today, like the commitment of traders and the open interest, we're expecting an explosive move over the next few months. But the coronavirus is holding us in a consolidation pattern. Now, why is this the same not happening on the GU? Well, in addition to the coronavirus on the GU, we're also dealing with still the after Brexit effect. So it's coming down conclusively in a way that the EU is not, because it's only corona it's dealing with. Now, this is my personal scenario for this week. It could be wrong, and I don't care whether it's wrong or not. I don't need it to be right to make money. I just need to be able to adjust if I see it's wrong. I see a market structure break there, a mini market structure break here, right? I see a run up in price into that region, and this itself is an order block. If you look at it this way, price came here and then somebody sent it away very sharply. So that meets the definition of an order block. I would expect to see this happen. Price to come back into that range. I may be wrong, but can you see how that would be a reasonable expectation? It doesn't have to play out, but it could be reasonable. That's all you need, reasonable expectation. One second. So there is another block down there. And in fact, I'm going to draw it to this level here. There we go. So if that's going to happen, then we should see at least 1 or 2 weeks of downward momentum. Also, if I stick the Fibonacci from here, so from this move here to there, let's flip it. You see that that level there is a discount. It's beneath the 38.2. And this, the middle is also roughly the middle of the order block. So we have, if this pans out, we have prices here right now. We have 374 pips to play with. If that's the case, I am now going to be stalking a short. So I'm going to drop now from, also I have my daily engulfing. Can you see this here? This here, actually, sorry, this here is was my daily engulfing from the end of last month. Price has come back in there and again has had a daily reaction. So this is all telling me, again, I could be wrong, but it's all seeming to confirm to me that this is a reasonable trade scenario. I don't need it to be right. I just need to know what to look for if it's wrong and not to jump in prematurely. So that's my prediction. Again, my prediction doesn't have to be right. I just need a scenario I'm waiting for. If that's the case, I have, let's see, from here down to the top of the other block, 260 pips to play with. If I now drop to a 4-hour chart, I'm going to take this away just so now that we know where we are in price. So that's the weekly consolidation zone. So drop down to a 4-hour chart. I'm also going to take away the Fibonacci so that they don't confuse us. And you see what's happening here. So this is the dollar move I showed you that has not fully manifested yet. We went from there to there. We didn't make this stop hunt. However, as you can see, one has been made here. If we go from here to here, from there to there, right? There has been a stop hunt made here. Can you see that? Let me take this away so you can see it. There has been a stop hunt made there. And price is now at a premium. It's above the 61.8 level. It's now at a premium. So, could it be, again, we don't know for sure, that this is now ready to move down? What we're going to wait for is a reversal on the 4-hour chart this week, somewhere between Tuesday and Wednesday, right? We're going to wait for price to do something. If this scenario turns out to be true, it could do this, right? Back above that level or in that region and come down. It could go even above. It could take out this level as well. You could have a double stop hunt. Happens all the time, especially at the start of a week or the end of a week. That's why I don't like trading Mondays and Fridays. Strange stuff happens. Let's get rid of that. However, how do we know we were wrong? Because as a trader, you need to understand when your scenario didn't work. Seeing as we're stuck in a consolidation, the market could just simply want to manipulate us first out of the consolidation. Let's take this away from there for a second. As you can see, there's a very enticing low here. Very, very enticing. And there's another block just beneath it. So my alternative scenario is that this could happen. Price goes in here. And then comes there. And then there. So those would be my two scenarios. I should have taken a picture of the first one, but let me take this one. That's one. The other one we showed was this. That it first just goes up somewhere in that region. And then this comes down. Whatever happens, we expect it to react here. And then from here, it could do one of several things. It could just go up again. So it could just go up again. Let me take that one. Or could come back into that zone and then do that. Or The one that I really like when it does is this. It pushes through the zone the first time, comes into the zone. These are all price action principles and patterns you learn, and then does that. My point is, whichever of the above it does, we're going into the week preparing to see one of these scenarios. And we're waiting for between Tuesday and Wednesday. It could, if it goes on a Monday, fine. We just do a Fibonacci retracement on Tuesday or Wednesday. We're stalking Tuesday, Wednesday, 6 to 10, 12 to 3, and looking to see something like this happen. And so if we see this reversal here, then we know that we can trust it to get at least. So if we see that reversal we're looking for here, let's assume we see it here. We know we can trust it for the next 150, 160 pips. So you could have just one trade that week for 160 pips and you're good. That's it. In essence, if I catch this up here and I can trade it all the way down there for a minimum of 5 to 1, I can walk away from EU for the rest of the week and I'm good. I don't need to risk anything else on the rest of it. I'm happy and I'm gone. And I look for something similar in another pair. Or if I miss this one and it comes back here and gives me another reaction here, I could get in here. Middle of the other block. And then I know I have at least, again, another 200 pips. But if I want to be conservative, get out here, that's another 120 pips. So you can see how we start to frame the trade plans in advance, such that when we do get into the week, we're not reacting, we are responding. So you do your top-down analysis. And then finally, and I'm going to end here for tonight, you set your rules and trade plans. Actually, this is 6. So I've just shown you rules and trade plans. Five is now I personally anticipate 3 scenarios for every pair on my watch list. So I've shown you 4 that could happen in EU this week, but you only need 3. I only need 3. Anticipate 3 scenarios for every pair on my watch list. You know what? I'm just going to move all these forward. So 6 is you set your rules and trade plans. And you include in your rules and trade plans, include signals, risk, and money management. Risk management, money management, and trade management. Look at the webinar from, I think it was Wednesday or Thursday last week. We explained all this. In essence, how do I know when my trade is ready to go? Like I told you, for me, it's a 1 hour engulfing in the right direction. I've predicted in certain times of the day. Where am I going to put my stop loss? Where am I going to put my take profit? What risk to reward ratio am I going for? How do I manage my trade? When do I come out? How do I know to abort the trade? When do I move my stop loss to even if I'm making a profit? When do I take half of my profit off the trade and leave the rest to run risk free? These are all things you plan in advance. If you do this correctly, insert text, and I'm going to end with this. If you do this correctly, trading should be boring but fulfilling. If you are an experienced, of course, if you're a new trader, it's always going to be exciting. What have I just done? Okay. If you're a new trader, it's always going to be exciting because when you do something newly, it's always exciting. But if you have been trading for anything more than a year and you still get excited by your trading, you're doing it wrong. It should be fulfilling, meaning you should, oh, that's nice. But it should be mechanical, boring. There should be no emotions. Well, not, you can't not have emotions, but there should be minimal emotions going in because you should simply be ticking things off a list. Yep, order block. Yep, market structure break. Yep, engulfing. Yep, Tuesday or Wednesday, or maybe early Thursday. Yep, 6 to 10. Yep, 12 to 3. Yep, 1 hour engulfing in the right direction. Yep, discount or premium Fibonacci retracement. Yep, 4-to-1 minimum risk to reward ratio, but we like 5. Yep, after we go past 3, take off half of my trade and put my stops at 0. It should just be mechanical, such that your brain can handle everyday life. You can be a father, you can be a husband, you can be a wife, you can be a mother, you can be an employee, you can be a member of your church, a member of the community. Your brain isn't so stressed out darting through and fro a pair of charts or set of charts that everyday life is stressful. Any questions? I'm sorry, I carried on a lot longer than I planned. I planned to end 3 hours ago, or 30 minutes ago for questions. But any questions? Any questions? And while I'm waiting to see if anybody has any questions, let's just draw your attention back to this. So this is the rest of the week for us. Monday mornings, there's no session because, like I said, we're not really Monday traders. Feel free to be in the charts yourself. Also, Joshua, please remind me the days you're free again. Please put them in the comment section, the days and times you're free again. If you want to reach out to Joshua for the beginners, feel free to do that. For the advanced or intermediate traders, you can reach out to Talkbear or myself. We will answer your questions during the week, even when there's no session. But Monday, 9:15, we're going to look at, after seeing what Monday does, we'll be in a much better position to predict what the rest of the week is going to do. That's why we do that Monday evening. Tuesday morning at 11 a.m., we're going to do live chart analysis as trades are playing out. Tuesday evening, there's a teaching session and a live chart session as well. Wednesday evening, this is only for the registered students. It's a closed forum beginner session. Thursday morning, again, another closed forum beginner session. Thursday evening, a closed forum advanced session for the advanced and intermediate traders. Even if you're an experienced trader, please, we advise you to come to the beginners forums. There will be something that you missed in your journey trading that will change your trading life. Every advanced trader who's been a part of our beginner session says there's something that they picked up from it that was amazing for them. Friday in the morning, we're going to round up the week with some live charts and analysis. And of course, Sunday, we're back again at 9:15. So any questions so far? Cool. So no questions. Great. So I did such a great job of explaining that there are no questions. Cool. So what do I want you to do? If you are a new trader, please reach out to Joshua this week or myself to make sure that your demo account is set up so you can start doing chart exercises and patterns. Get a notebook and a trading journal so that you can track the trades you're taking on your demo account and learn from them. If you are an advanced trader or an experienced trader, or at least an intermediate trader, draw up your trading plan. What are the rules? Let's see if I can find that screenshot. What are the rules that you trade by. One second, let's see. No, not that one. What are the rules that you are trading by that's going to help you be mechanical in your approach? This is all from last week's sessions. Right. So what are your rules? If you don't have them already, please get in touch with either myself or Talkware so we can help you develop a trade plan. Let's see through how you look at the markets. One second. Also review some of your previous history. What is going on here? And help you come up with a set of rules that works for you. Right. No, I can't find that. That's fine. When I do find it, I'll send it in the group, the screenshot on the trading plan checklist. So plan your, so how are you going to trade this week? What are you going to be looking for? What's your watch list? What are your signals? What are your scenarios? And therefore we can hold you accountable during the week and say, did you execute exactly what you said you were looking for? If what you predicted happened, did you take the trade? If not, why? Were you afraid? Or if what you predicted did not happen, did you still take the trade? If so, why? Were you greedy? And then we can review at the end of the week on a Friday, going into Sunday next week. All right, guys, that's all for me. It's been 2 hours. Great having you on board. Go back, as usual, watch the videos. It'll be up on YouTube. It's actually going to be publicly available on YouTube, so you can go back and look at it, even if you don't have the link. Registered students, I will see you tomorrow, or Talkware will see you tomorrow at 9:15 in the evening, and I'll see you at 11 a.m. on Tuesday morning. Take care. Have a great week. God bless you, and have a very productive week in the other areas of your life. Bye, 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 bye.